What are your favorite IRS legal loopholes?
Right now, the short-term rental strategy, absolutely, because I have a lot of W-2 taxpayers that are super high net that don't have any write-offs other than their 401k. So if we get them to invest in a short-term rental, manage that short-term rental themselves for 100 hours in the year, but the customer has to stay in the property 7 days or less on average, we can turn a Airbnb or VRBO into an active business on the tax returns. So if I accelerate depreciation with the cost segregation study, I can force a paper loss, and that paper loss flows over to offset W-2 and 1099 income. That's a loophole because most people who were investing in real estate and only were able to offset just their passive income. Now you have the ability to offset both passive and active income.
All right. So they're talking about something called the short-term rental loophole. You hear a lot about it. My experience is that it's extremely powerful for those who are willing to do those short-term rentals. And he's right. In order to qualify as a short-term rental, the average usage has to be 7 days or less. Typically, there are some other things, like if you're providing extraordinary amount of services, it could even be 30 days or more. But for regular folks like you and me, most of the time we're looking at it, and you have to actually materially participate, which is what he was talking about with the 100-hour test. And that's just one of 7 qualifiers to actually qualify as a material participant. So there are other ways to qualify. The easiest one is to self-manage. And if you self-manage, technically there's not a 100-hour requirement. So that's one thing I would just say is if you are self-managing your own short-term rental and nobody else is providing substantial services, then you're automatically going to qualify. If anybody else is providing services, like you have it being cleaned or things by other people, then you have to be 100 hours and more than anybody else. He doesn't specify that, but again, this is just getting into into a little bit of the weeds of what you actually have to do. And what it does is it makes the loss from that activity non-passive. And when you're typically investing in real estate, your losses are considered passive if it's rental real estate. When you're doing the short-term rental loophole, it's no longer rental real estate by regulation. It's considered a trade or business if it's 7 days or less, which means you may as well be running a pizza shop at a loss. I get to use that loss so long as I structure it correctly. So you can't put it in a C Corp and get this. You got to make sure that it's flowing onto your tax return. And if you do it, yes, you could end up having a loss that offsets your W-2 income or your other active ordinary types of income. Now, if you like this type of thing and you like these reaction videos, please subscribe. I'm a tax attorney giving you actual tax tips.